Welcome to all of you in my today's session. As all of you know that due to COVID-19, we are all locked in at our home. That's why I am using this virtual media for delivering a session on real option. Now, what is real option? Real option, it's a hybrid, it's a blend, it's a mixture between two financial instruments. One from capital budgeting, that is NPV, net present value, and another one from financial derivative. Now let us, before going to real option, let me first give a small introduction about financial derivative. Now, what is derivative? Derivative, as all of you know, we are using this concept in our mathematics, calculus. We have a differential calculus. There we are using first order derivative, second order derivative. And this derivative, which is actually that without that underlying, that is dependent variable, derivative doesn't have that dy dx. So, without y, ddx is the derivative, that ddx doesn't have any existence. Similarly, in finance, we also use a concept called financial derivative. That is also the same thing. It's a financial product which has been derived from another financial product or commodity. Without that particular underlying asset, it doesn't have any independent existence. And financial asset can be anything. It can be commodity, it can be financial stock, it can be equity, bond, debenture, it can be real estate, it can be gold, it can be commodity, anything, any financial asset. So we have to apply these particular instrument for risk mitigation, for hedging, this derivative instrument for the against the price fluctuation of any financial asset, like any commodity. It can be gold, it can be copper, it can be real estate, it can be stock, it can be foreign exchange, any financial asset. Now, derivative, there are various type of derivative instruments we have. We have forward, future, we have swap, we have FRA, forward rate agreement, we have options, call and put options. Now, here in real option, we will use this option mechanism of derivatives in real option. Now, just giving you a brief overview of each one. Like in case of forward, what happened? Like this, as because of this COVID-19, we don't know that there is a huge slump, huge downfall in share market, and we don't know that what will happen to our stocks, what will be our portfolio value. Then suppose I require, or maybe our currency, I require after 3 months, I might require for any of my import requirement, I might require 1000 USD. Now, I don't know that what will be the price of USD after 3 months due to this global crisis because due to COVID-19. Now, there I can book a forward contract by which I can book my price. So, here using this derivative instrument, I can book my future price for a particular quantity, qualities, everything is specified. I am booking the price. So, whatever may be the actual spot market price after 3 months, but I will have my product at my specified earlier fixed price. That gives me an insurance against price fluctuation. That is about forward. Same thing about future, only the difference between forward and future derivatives is that future is more standardized, whether forward is customized. Future is through the stock exchange. That is why it's more here securitization, here mortgage is and the safety instruments are much more there, and it's more standardized. So lot size is fixed, maturity date is fixed, so everything is fixed. So future is more formalized, whereas forward is more customized in nature. More in that case, it is more user friendly. It can be available at any lot size and in varied maturity period. So that's about forward and future. Similarly, there is another derivative instrument which is known as swap. The swap, as we know that the meaning of swap, it is that we mutually exchange some product or something for our own benefit. The swap here, suppose for an example, suppose for an Indian farm who is very accessible for INR loan, but he is looking for a Singapore dollar, whereas a Singapore farm who is also is eligible for a very finer rate of Singapore dollar, but he is looking for INR loan. Now, what they will do, so Singapore company, they will borrow Singapore dollar at a cheaper rate, and Indian company, they will borrow at INR at a cheaper rate from Indian bank, and then after borrowing from their own currency, from their own bank, then they will swap the currency each other, and the interest principal amount will be exchanged and interest will be paid by themselves, or interest can be also swapped. So they both will get the benefit. Like Singapore company, they don't have any access in INR loan, but they will get INR by this because of the swap arrangement. So that is about swap. There is another derivative instrument which is known as option. Option gives you a choice, and it gives you a much more protection even against more protection even for forward itself. Like in forward future, what happened, you have booked the price, so your price is fixed, so you don't have any price fluctuation risk. But it may so happens that in real world, in spot market, your spot price might be lesser, so then you will be loser in case of forward or future contract. But option gives you another protection. It gives you maximum amount of insurance in case of option. So you have a choice. If you have an option, if you are holding an option contract, you have a choice that you may exercise your contract or not. There is no obligation. You have only the right. So if suppose your earlier booked price, exercise price or strike price, if it is favorable for you, you may exercise. When it is favorable, when you are supposed to buy, then suppose your exercise price is less than the spot price, then obviously it is beneficial, then you will exercise. But if the situation is opposite, then you will not exercise. So that is about that gives you the additional advantage, additional insurance in case of option, which forward doesn't give you. So that this option can be generally two types. It can be call option and put option. Call option when it gives you a right to buy, put option when it gives you a right to sell. Okay, now this option concept we will use in our real option. And as all of you know, in capital budgeting, broadly two types. There are DCF technique and non-DCF technique, discounted cash flow technique and non-discounted cash flow technique. In discounted cash flow technique, we use time value of money, and there the most popular and most conceptually sound method is NPV, net present value method. How we calculate net present value? That how much value a project or an investment can create on behalf of its shareholders. So how we calculate net present value? It is the present value of cash inflow minus present value of cash outflow. So in real option, what we'll use, we will mix this NPV method as well as this option derivative, financial option derivatives. We are combining these two in real option. How and why I am coming next. So this is the example of a call option. Look at it is the option for an currency option. Here we supposed to in call options we supposed to buy. So we supposed to buy dollar. So in that case, see, look at the graph. This is the first one is the option buyer's perspective, and second one is option seller's perspective. One is for option holder, another is option writer. Call option, both the cases. So, and 0.5, 50 paisa per dollar is option premium, and 46.50 per dollar, it is the strike rate or exercise price. Now look at, if your spot, and this horizontal axis is spot price axis, currency value, and the vertical axis is the profit axis or payoff axis per dollar. And look, suppose your spot price is less than exercise price, say it is 40, then at this juncture, then we will not exercise, because you will not buy at a higher price, which is 46.5, whereas you will buy from the spot market at 40. So your loss is the premium value, that is 50 paisa. And when it will spot price is more than 46.5, then you will start exercising, and you will start to earn profit. And when it will cross 47, suppose your spot price is 50, then obviously you will exercise, and your benefit is rupees 3, your profit is rupees 3, 50 minus 47, benefit is rupees 3. Why? Because 46.5 is your exercise price that you have to pay if you exercise, and 50 paisa is your premium. So 47 is your outflow, and actually this for what the price of that product is in the market is now 50. So your net benefit is rupees 3. So that is the benefit. So suppose, depending on, as we don't know that what will be my currency value, so we may go for call option. So if suppose that as per the spot rate, if it is beneficial, then we'll exercise. If it is not, then we'll not exercise. Only my loss, a maximum amount of loss is my premium value. So here I can limit my loss amount, whereas profit can be anything. It is unlimited profit. That is the benefit for a option contract. The mirror image of option buyer is the option seller. When buyer is making the profit, it is seller is making the same amount of loss. Look at the mirror image. It is for the option seller, it will be clear. When buyer is making profit, seller is making loss. Next, go to the put option perspective. Here the profit diagram of a put option buyer and put option seller. And put option means it gives you a right to sell. Here it is my same exercise price, strike rate 46.5 per dollar, and option premium 50 paisa per dollar. Here when price is rupees 40 and the vertical axis is payoff and horizontal axis is spot price. So when in spot market price is 40, then obviously you will exercise, because you want to sell. Now you have a right to sell. So you have a put option holder, you are a put option holder. So that means you want to sell at a higher price. At what price you will sell? You will sell your fixed price, that is 46.5. So that means it is your profit. So as long as your price is less than 46, that is 46.5 plus 50 paisa premium, 46.5 minus 50 paisa premium, so 46. When it is less than 46, you will earn profit, and when it is 46 more than 46, you will have a loss. And the maximum amount of loss here also, it is up to the premium amount, that is 50 paisa. That is the maximum amount of loss. So this is about the put option perspective. Fine. And same here, put option buyers, when they are making profit, put option seller, they will make loss. Now come to the real option. Now what it is? As it is said by Triantes, that real option is sometimes a little like an extreme sport. People look at it and say, oh, that's really neat. it's fun to watch. But when you actually sit down and try to do it by yourself, it's not so easy. So why it's not so easy and how it is going to be difficult, but it is actually very much beneficial to take a decision mainly during any crisis period like COVID-19. That's why I am putting this particular concept in today's discussion. Now, what is real option? Real options are also a kind of options on real assets that can be defined as opportunities to respond to the changing circumstances of a project. These opportunities to change consist of rights but not the obligation to take some action in the future. This definition of real option has been given by Dixit and Pendick in 1995. This concept it came in 1995, not so old, and how it is actually happening here. Now, in case of NPV, in case of capital budgeting, what happens here? This decision is irreversible. Once you have taken the decision, you cannot revert back. Suppose in pre-COVID-19 you have started a project. Now, due to this lockdown and due to this COVID-19 and now this social distancing, now possibly that particular project, suppose you have planned for a movie to produce a movie, now that may not be feasible in this current scenario. Now you have to delay the project. Now in case of NPV evaluation, what happens that once you have taken the decision, you cannot plow back your decision. It is not possible. It is irreversible. But that flexibility, it has to be there in real life, because we have to take our decision according to the situation, and every day situation is changing because our life is full of uncertainty. So that's why we have to add flexibility with our capital budgeting or NPV decision. That's why this concept of real option that has been given by Dixit and Pendick, that why don't we mix up financial derivative, that option concept, with NPV. That yes, we will calculate NPV, but with an option that if suppose my situation is favorable for me, then I will exercise, then I will execute my project, or if suppose it is not, then I will not exercise, I will not execute my project. So I have a right, I don't have any obligation. That is about real option. So it is a hybrid of NPV, net present value, and financial option. And how we calculate value of the project? The project value is NPV as per my DCA capital budgeting method, NPV plus option value. NPV, how we calculate? We calculate NPV by our traditional way, that is present value of cash inflow minus present value of cash outflow. And how we calculate option value? We will use Black-Scholes option pricing model or binomial option pricing model that generally we discuss in option pricing session. In real option, in today's session, I am not going in depth of this Black-Scholes option pricing model because it will further lengthen the session. So we'll calculate, my point is, we'll calculate NPV of the project as per the NPV DCF method, and we also calculate option value, it can be call option or put option, by using Black-Scholes option pricing model or binomial option pricing model. And as all of you know that Black-Scholes, it's a famous model, and they got Nobel Prize because of this model. So finally we arrive a project value, which is a summation of NPV plus option value. Now obviously the greater the number of options, the greater the uncertainty you have. So greater will be the option value, and hence greater will be the value of the project. So that means, as we know that when there is more risk, the stocks is having more risk, they will give you more return. Similarly, here if uncertainty are more, if options are more, that will have more uncertainty, and that will have more option value, and that will increase your project value. And what are the two types of real option that we can use? It can be option to expand or option to abandon. Option to expand, where we are using the concept of call option value. That means when suppose we are continuing our project with a limited opportunity, then if situation is beneficial in near future, then we may expand the project. So that means we will buy the project if situation is favorable for me. So that is, it gives me a right to buy, gives me a right to expand. So that's why it is option to expand. Here we are using the call option concept. There is another one which is option to abandon. That means if suppose situation is not favorable for me, like this COVID-19, I have to terminate the project or I have to close down my existing business, then what will be the value of that shutting down of my business? Option to abandon. That means I will use the put option concept. So what will be the disposable value of my business? So that will be the put. I am using the put option. The same call option and put option we are using in case of real option also, by calculating option to expand and option to abandon for an existing project. Next, look at the graph. So this is the option to expand a project. Look at that, initially that project is giving you negative NPV now, and cost of expansion, when this NPV it will be more than cost of NPV, so you will reach positive NPV. When you have positive NPV, then finally you will execute the project and your present value of cash flow, and finally you will have your positive NPV is going to be it will be increasing more and more, and gradually you will have a profit in your project. So that means it is the case of a call option. Earlier I have shown you the graph for profit diagram for call option. It's same like option to expand a project. So that means you are undergoing the project, but once its NPV value is more than cost of expansion, then obviously you will go for that. But when NPV is less than cost of expansion, then you should not go for expansion of the project. You should not think about the expansion of the project. That is about option to expand. Next, by similar just opposite case, it is option to abandon. Here when initially you have the project is having negative NPV, now there is a salvage value of abandonment. Once you reach the more than your NPV is more than that, then gradually you have a positive NPV, and finally your project is going to be feasible. So that means when you will use that, when you continue this project, if your project is more than the salvage value, then you will continue the project, otherwise you should abandon the project. That's all about the option to abandonment of the project. Next, I will bring another concept which actually we may use during this crisis period. Suppose all of us, we have some amount of money, we generally invest in share market. So then we are in an utter dilemma that what to invest, which stock I may hold, or which stock I may sell, or which new stocks I should buy. So we have a dilemma in the, and after this COVID-19, in the post-COVID-19 era, what will happen in the industry, what firms will survive, which firms will survive. So we have lot of dilemma in our mind. So Here we can apply this concept of real option, which it has been applied by Lohermann's tomato garden. It was a famous case by Timothy Lohermann. It was done in 1998. It has been used, the concept of real option, for his tomato garden. And the paper, it was written in 1998, that is known as, it is a famous paper, Strategy as a Portfolio of Real Options by Timothy Lohermann, where actually Lohermann had calculated two things. One is called V, which is denoted by V, volatility, that is uncertainty. It can be low, it can be high. And how volatility will be calculated? It will be calculated that sigma into square root of t, where sigma is the standard deviation of the product price, standard deviation against the product price of the product price fluctuation of the product, and time is that the time period from taking from the point of decision to point of execution. So that is about the time. And Lohermann has two components. One is volatility, another is value to cost. Value to cost. Now, how it is actually NPVQ, NPV suffix Q, how it will be calculated, value to cost? It is stock price, that stock which I want to invest, stock price, divided by its cost, that is present value of its exercise price, present value of its exercise price. Exercise price as I will pay on a future date, so that means what will be its present value. So that is value to cost ratio. It is how we calculate, I repeat once again, it is stock price upon present value of exercise price. Now, in Black & Scholes option pricing formula, we use this stochastic calculus. Here also we will use this, that how we calculate present value of exercise price. If suppose risk-free interest rate is RF and time is T, as I have already mentioned, then my present value of exercise price or strike price is, exercise price into e to the power exponential e to the power minus RFT, where RF is the risk-free rate of return, risk-free rate of interest, and T is the time period. And horizontal axis, the figures measures the value to cost, and vertical axis signifies the volatility. And in Timothy Lohermann's tomato garden, it's having, he has segregated his garden into 6 regions. Region 1 to region 6. R1, R2, R3, R4, R5, R6. Let us look at this graph. Look at this. Horizontal axis is the value to cost ratio of, and look at this rectangular garden. It has been divided, segregated into 6 regions: R1, R2, R3, R4, R5, R6. And this gardens, this horizontal axis denoted value to cost. How we calculate value to cost? It is NPV by using stochastic calculus. It is value means it is the stock price, current spot price of a stock, divided by cost. Cost is the present value of exercise price. So that is the value to cost ratio. And vertical axis is denoted by volatility. And volatility, it is the uncertainty. How we calculate volatility? It is sigma root 2, sigma root t, where sigma is standard deviation of the stock price, and t is the time from the point of discussion to point of execution of the decision. Okay. So we have a vertical axis, volatility, which the upper one is the low side of volatility, and below one is the high side of the volatility. So volatility is changing like from low to high. Similarly, value to cost, it starts with 0 and then it will go to 1, and it can be more than 1. So my region 1, it is where value to cost is greater than 1 but volatility is low. Region 2, where value to cost is again greater than 1 but volatility is going to increase. And region 3, its value to cost is greater than 1 but volatility is high. And region 4, its value to cost is less than 1, negative, but its volatility is also high. And region 5, its volatility is low to high, and value to cost is also negative, less than 1. And in region 6, its volatility is volatility is 0, low, and value to cost is less than 1. So in this way, Timothy Lohanman, he had segregated his garden into 6 regions, and he wants to take a decision that the tomato, the shades which will be cropped in these 6 regions. Now where he should crop, which region he should crop and which region he should not. So in his entire, suppose 1 acre of tomato garden, then which particular region he should crop the tomato shades and where he should not. That's why he segregated his garden into the 6 regions according to their value to cost and volatility. Now look at this next table, that's tomato garden. There are 6 regions, R1, R2, R3, R4, R5, R6, and in region 1, its value to cost is, as I have already said, it's greater than 1 and volatility is low, and here the tomatoes will be ripe. That's why you should invest now in region. Now you immediately invest, because it will give you ripe tomatoes after 3 months. This is the cropping season, so after 3 months it will give you ripe tomato. So you should invest now if you are in region 1. If you are in region 2, then it is volatility is greater than 1, positive, but value to cost is greater than 1, positive, but volatility, it will going to increase. So there are uncertainty, risk are there. So that means you should invest, but there is a might. You maybe now invest. So here your tomatoes will be imperfect but edible. So you can easily sell in the market and you will earn profit. But their quality may not be as good as in region 1. That's about region 2. Then region 3, here value to cost is greater than 1, positive, so return is high, but volatility is very high. So that's why it will give you a tomato which is inedible but very promising, because that your tomato will be there are uncertainty is high, so tomato may not be ripe properly, but as value to cost is positive, so it's promising. So that means you may hold on this. You probably later, in a later period, you may invest, you may crop in region 3. If you have excess demand in the market, maybe not now, maybe after 7 days or after 10 days, after 15 days, when you see that market is the product, demand of your product is more, then possibly you will invest in region 3, but not now. Now what about region 4? Region 4 value to cost is negative, less than 1, but volatility is low. Your risk is less. So that's why here less promising green tomatoes. Here tomato will be there because uncertainty is very low. You can able to crop tomato will be there, but whether the market will be there or not, that is a point of concern, because value to cost is less than 1. So that's why you once again you will hold this decision. Maybe later, if suppose because of high demand of tomato, you may increase the price, so your value to cost might increase. So you may decide this later on, not now, for region 4. Now in region 5, what happened? That value to cost is less than 1 and volatility is very high. So late blossoms and small green tomatoes. So as uncertainty is very high and return is also negative, so that means if you are in region 5, you will probably never invest, probably, because that if suppose there are rarest of the rarest chances that even if your small green tomatoes are having demand in the market, so you may invest that time if situation is that promising. Fine, but not now. It's a big no if you are in region 5. If you are in region 6, then your value to cost is less than 1 and volatility is low. So your decision is you will invest never, a big no, and your tomatoes will be rotten. Okay, so that's about Timothy Lohrmann's particular paper, which I thought that we may apply this Lohrmann's tomato garden concept in today's dilemma during this COVID-19, where we are in a utter uncertainty that where to invest, how to invest, which stock I should hold, where I may invest later on. So we are in a dilemma. So we can use this Timothy Lohrmann's tomato garden concept in today's stock market as well. Look at, now I am using this Timothy Lohrmann's example in case of stock price. So let us we have in case of 6 regions in tomato garden example, I am using 6 different stocks here. My stocks are A, B, C, D, E, F. And all are having, suppose today's stock price for all these 6 stocks, they are similar in nature. All are having stock price is similar, 100 rupees. That's why I have a dilemma that whether I will buy A or sell C or hold D or which one. Okay, or in maybe in what portfolio. So in A, B, C, D, E, F, I am in a dilemma. All are 100. But what will happen this 100? I don't know for A, B, C, D, E, F. So where I should invest, which stock I should select. Now the exercise price, strike price, say after this COVID-19 issues, post-COVID-19 era, maybe after 6 months or after 3 months. So this exercise price for A, B, C, D, E, F, that is as per the call option contract, it is given that there are various exercise price for different stocks, and time are also different for 6 stocks that is given. I have taken 6 different time zone. So that means, and standard deviation during this time period, that also I have calculated, that is given stock A, it is 30%, B 30%, C 30%, D 20%, E 30%, F 40%. So it is like the standard deviation per annum. And risk-free interest rate, I have taken, it is 6%, though in current market it is a little bit lesser, but I have taken it is, say it is 6% RF, risk-free rate of return. So risk-free interest rate is 6%. And so NPVQ, that value to cost, how we calculate the Timothy Lohrmann's gardens, tomato gardens, this horizontal axis, that is value to cost. How we calculate value to cost? It is stock price by present value of exercise price. Stock price, that is S, that is the second row. For A, it is for A, B, C, D, E, F, it is 100, it is same. And present value of exercise price, how we calculate? Suppose for A's exercise price is 90, so what will be its present value? It is 90 into e to the power minus RF into T. So it is 90 into e to the power minus RF is 0.06 into T is 0. Okay, for B it is once again 90 into e to the power minus 0.06 into 2. So we calculate value to cost for all 6 stocks A, B, C, D, E, F. And we also calculate volatility, that is the vertical axis of tomato garden, which how we calculate as per Timothy's concept, it is sigma root T. Sigma is the standard deviation per annum that we have already calculated for all 6 stakes, and we have the time zone for each stocks. So sigma root T, I will calculate standard deviation into square root of T. So I have volatility for all 6 stocks. Now, call value by using Black and Scholes option pricing model, I may calculate call value for all 6 stocks. So I have done this, and that is S minus AX. It is the intrinsic value for the all 6 stocks. So it is the difference between spot price and exercise price. So then if we check all these 6 stocks, then if we compare with Timothy's tomato garden concept, then my stock A is in region 1, stock B in region 2, stock F in region 3, stock E in region 4, stock D in region 5, and stock C in region 6. Why stock A in region 1? Because its value to cost is greater than 1 and volatility is 0. Why C is in region 6? Because its value to cost is less than 1, and volatility is 0. So that's why it's region 6. Similarly, we have we can segregate these 6 different stocks in which region they are actually belonging. So I have stock A in region 1 and B in region 2 and F in 3, E in 4, D in 5, C in 6. So as for Timothy's decision, so I should invest now for in stock A because they are in region 1, and I should not never invest in stock C because they are in region 6. Similarly, I maybe now invest in region 2, that is my next choice, but that is stock B, and probably maybe later period I may invest in stock F, which is in region 3. May not be I will invest in region 5, and maybe later period I may invest or may not, that is region 4. So as for my choice, as for my priority for investment in stocks, A is the first priority, B is second, F is third, E is fourth, D is fifth, and C never. So that's in this way, we can utilize this Timothy Lohrmann's tomato garden concept of real option in today's dilemma, that what to invest, how to invest, what to invest. But there is a concern in case of real option route. That concern has been shown by Van Putten and Macmillan in 2004, that for all their theoretical attractiveness, real option is theoretically very sound, very attractive. But although they have their theoretical attractiveness as a way to value growth project, real options can have had a difficult time catching on with managers. Why? Because CFOs tell us that real options overestimate the value of uncertain projects. They grant excessively ambitious managers a license to gamble with shareholders' money. So that's the problem in real option. It's more or less, it's a gamble, so there is a chance of risk. There is another concern, it has been shown by Favito and all in 2005. They have said that complexity of the stochastic calculus prevents practitioner to see the new decision space created by real options and to move inside this space at ease. So as I have said that in real option we use stochastic calculus, which is high-end mathematics, and generally for a layman it may not be possible to understand the nitty-gritties of stochastic calculus. So that may be another problem. So people are avoiding this particular concept. So these are the concern in real option that is very much there, though it is very much beneficial, but there are concern in real option. That is there. Now I'm just coming in my last topic of discussion, that I have started my discussion with how to what are the way out in today's dilemma regarding stock investment. Now, during this, with the help of my one of my ex-student, I have started a research work that what will be the financial impact of Indian firms due to this COVID-19. And we have segregated our study during lockdown phase 1, lockdown phase 2, and now we are doing for lockdown phase 3. Now what we have seen that during lockdown phase 1, that all the industries except pharma, all are making negative return. So they are making loss. All the stock prices, their prices will fall. They are making negative return except pharma industry. Why pharma industry? We all know. Now in lockdown phase 2, look at the graph, the situation has been changed, and where the industries which are firms which are earning negative return in lockdown phase 1, now they have started earning more, and some of them have already reached the positive return also. So there are changes. Now we have a basket in front of us, various industries, different firms. We have done these studies for NSE 100 stocks. Now out of these 100 stocks, we have segregated in different industries. Now here, from there, we can apply this Timothy Lohrmann's tomato garden concept, that which stocks, by calculating their value to cost and volatility, and we may decide that which stock I will invest now, or maybe later, or may not be later, probably never, or not at all, that whether in region 1 to region 6. So we'll segregate this NSE 100 stock, and we may decide that where to invest, how to invest. So in that way, we will use real option concept, we'll use Timothy Lohrmann's tomato garden concept in today's dilemma, and we may have a solution in this crisis period. Now with this, I'm closing my session for today, and it's for everybody, as the outside situation is not so good. We are facing a lot of crises due to this COVID-19, and due to lockdown phases, a lot of economic problem. We have to face the consequences. Now my request to all of you, stay safe, stay at home, and have a good day. Thank you very much.